Yeah. You should be able to see a document that says seller financing. Thank you, Angela, for doing some touch up,
You're welcome.
much like my haircut. Is that taking up the whole screen? I don't know, for some reason. Here, maybe I can do this. All right. How about that? Yeah, everyone talks about seller financing. No one does anything about it. I'm starting to see it happen more often. It goes through cycles. But because I've had this come up maybe 5 or 6 times in the last 6 months or so, I thought, gee, there seems to be a trend. It used to be more common, particularly when interest rates were higher. And you might be thinking, well, interest rates are really high now. I mean, back when they were in the good old days, right? 10%, 12%, right? And so you have a buyer that doesn't have 20% down, but they really need the rate and terms that you would get from an 80% loan, which would be no PMI, better rates and terms, but they don't have 20% down, but they get the seller to lend them 10%. And then they would put down 10%. That's called an 80-10-10. Right? Now, Badal and I were reminiscing about this, but now you could get a loan from Badal that's already at 90%. They've sort of absorbed that, but this was a really common thing. I mean, it was like there was, and sellers would put that actually in the multiple listing service in the comments to the other agents that the seller is willing to consider financing. Right now, why would the seller care about this? Well, you might be able to get more money. And there are some sellers that don't need the money right now, right? They don't really need the money right now. So if they lend money, and by the way, seller financing is when the seller obviously lends money to the buyer, the interest rate on a loan from the seller would be 1 to 3% higher than what the market rate is on interest rates. Right, so if it is 7% is the normal, plain vanilla get a loan interest rate right now, it would be 9-10% on seller financing. But then, yeah, so there's that. But then on the plus side, maybe the buyer can't qualify for a normal loan. I'll give you some examples of when that might come up and when the seller might want to lend money. Let me see. I think I went through that. We're going to go through this form, which is the California Association of Realtors Seller Financing Addendum and Advisory. And I had Google Notebook LM make an explainer video, but I just wanted to explain a couple of things before we go to the form. So, seller financing, technically speaking, is not installment sales contracts. And they're not option contracts like a lease option. So we're going to talk a little bit because this is in the form, but there's an argument to be made that the land contract, the real property sales contract, the installment sale contract, is not really financing in the traditional sense because you don't get the legal title to the property, right? You understand you're paying in installments and then you get the legal title when you're done, but you didn't really finance the legal title because you didn't get that up front. You understand? It's a technical thing, but we generally lump land contracts into seller financing because it's an agreement by the seller, to let you take time to pay them off. And a lease option is not really seller financing either, because that's where typically where the buyer doesn't have the down payment. So they sign a lease that says, usually at a little bit higher than normal rent, but it says that they get a portion of the rent that they pay to be used as a credit towards a down payment should they buy the property at the end of the lease. And then they have an option at the end of the lease to buy the property or not to buy the property. That's also not seller financing, right? Although a lot of times all of this stuff is thrown into one category because these are ways in which somebody who doesn't have a house can move into a house based upon different ways of financing it. All right. So hard money versus soft. Now, some people, especially if you've been in the business a while, are not going to like this. But the term hard money per se is not actually defined in virtually anywhere. And the only time it really is used in the California Civil Code is in the context of a discussion on deficiency judgments. And what a deficiency judgment is let's say the lender lends you $800,000 to buy a house. The market crashes. Your house is now only worth $600,000. You stop making payments because why throw good money after bad? The lender forecloses, but the lender only gets $600,000. They lent you eight. They're angry and they're coming after you. They want the other 200,000. That's a deficiency. And they're trying to get a judgment against you. And in that context, the term hard money means any loan where cold hard cash is actually used in the transaction. So if you get a loan from Bank of America or ongoing mortgage or a credit union, is that a hard money loan? Is that a hard money loan? And usually people in real estate would say, no, that's not a hard money loan. Well, but does it involve cash? Because usually people say, well, hard money is cash. And well, but if you get a loan through Badal, does Envoy actually lend cash? And the answer is yes. They don't give it to you. And the reason that this is sometimes confusing to borrowers, because I've had people ask me, is because they want to see it, right? I've had people say, the $800,000, can we see it? There's a scene in Breaking Bad, where he has a storage, he's got a big pallet full of money on it, maybe that's what they were, but they don't let you see it. Can you roll around in it and throw it in? You don't get, but they really do put money into escrow, right? And so in that case, all of that is legally considered a hard money loan, as opposed to what's called soft money, which is where a seller gives credit because it's soft in that the seller doesn't actually put money into escrow. They just, they signed it over, they carry back a loan. Now, when we're typically using the term hard money in the real estate world, don't try and, repeat what I just said to people that have been in the business because they'll say you're wrong. Just say, okay, all right, hard money means cash. What really the difference is that it's the difference between purchase money and non-purchase money. In that if you get a conventional loan, right, from a Fannie Mae, Freddie Mac, FHA, they're really lending money based upon the borrower's credit and income and all that sort of stuff. The hard money loans are not really lending money for a borrower. They're really just lending money based upon the security in the asset, right? Whether or not they can get their money, they're basing it on the property. They don't care that you're a unemployed, bankrupt, convicted arsonist, right? If the property has enough value, they're still probably going to want to get into it. Right. Now that is hard, just so that we know the different terms. There's also, you're going to see the phrase purchase money versus non-purchase money. And a purchase money loan is a loan to purchase real estate secured by the property being bought. Secured by the property being bought. A non-purchase money loan is a loan which could be used to buy real property, but it's secured by property that the borrower already owns. An equity loan, for example. So I had a client that was always writing all cash offers. He had a letter, from the bank that said he had that much, he had enough cash. But in reality, he was always getting a loan, but he was doing it on a property he already owned. He already had a line of credit. Right. But that's not a purchase money loan, right? Because if you have a line of credit, the money isn't secured by the property you're buying. It's secured by property you already own. Right now, if you're wondering who cares, because the difference has an effect on what legal protections you have. This is why there's several disclaimers that say talk to a lawyer if you're going to be doing this, right? Because if it's a purchase money loan, a loan to buy property secured by the property being bought, then there's a deficiency judgment protection. So if the lender lends you 800,000, but the value goes down and it's only worth 600,000, that $200,000 deficiency, they can't do anything about it. Not if it is a 1 to 4 unit owner occupied property where the loan was used to buy the property. You can't do anything about it. However, if you refinance that purchase, then what happens is you've converted a purchase money loan, which has anti-deficiency protection, into a non-purchase money loan, a loan against property you already own, and that protection could go away. So these are parts of the whole process. All right, so let's look at the form, because that's why you're here, isn't that right? You want to get to the form. I'll explain land contracts when we get to the form. And there's a link. And it does not exist. Well, that's just fine. Is that what everybody gets? So let me see. I'm relatively certain that well, how embarrassing. So let me do this. And then I will share that. That's really weird. Replace, so it's here. All right, let me just see where it is. Maybe I shouldn't have done that, but I'm gonna get a copy of the form again. All right, so here it is. I'm gonna share it. Anyone with the link, all right, copy the link, put that into chat, and eventually we will put it into the handout. And I don't know why. But operator error. All right. So here's the beast. Everybody can see the form. Yes. Is anyone still out there?
Yes, we can see the.
Yes, I can see it.
I can't hear you breathing or anything, so I'm not sure. Notice our friend Google's Gemini is already reading the nosy, bot that it is, the form, and asking if you want to summarize it. Now, to begin with, they ought to be talking to an attorney and or a tax person, because a lot of this has to do with the way in which they structure a sale. For example, if you were a seller and you were doing seller finance, what do you want? A high interest rate, right? Or would you want to get more for the sale of your property? Now, if you're doing the math, you might say, well, wait a second. If I get a high interest rate, interest is treated as ordinary income, and I have to pay tax on that. However, if I don't charge them very much interest, but they pay me an extra 50 grand or so for the property, that's capital gain. And capital gain is taxed at a different rate than ordinary. Does everybody see there are issues here? Right? There's issues that somebody ought to think about, which means, unless, a financial planner or sort of a tax professional, you get the idea, CPA. right? And when we get to land contracts and all-inclusive trust deeds, lawyers, and you'll see why. But and by the way, let me just give you my, whether you want to hear it or not, my cynical philosophy, right? Because I've explained this many times over the years. If this is what I'd say to the seller, if if those buyers cannot get a loan from Envoy Mortgage, Bank of America, Wells Fargo, they cannot get a loan from any normal lender. Why would you want to lend them money? I mean, think about this, right? Nobody else will, right? And so, and by the way, the California Civil Code says that if you're doing this as a seller financing, you are obligated by law to make sure that the borrowers qualify for the loan you're giving them, because this all falls under predatory lending rules. Right, so you're supposed to go through the, are you employed, how much money do you make, credit check, right? You're supposed to do all that, right? And still want to lend the money. Now, I'm telling you from practice, very few sellers actually do this, right? They usually just say, oh, okay, cool, yeah, well, yeah, why don't we do it, right? But you're supposed to go through the whole qualification process. Legally, you're supposed to do that if you're a seller. And by the way, if you're a seller and you're doing this often, you're now going to be treated as a lender, and a whole bunch of new rules will come down. All right, so now let's get to it. Paragraph 1, principal, interest, payment, maturity terms, principal amount. That meant, all right, how much are you borrowing? What's the interest rate? Okay, that sounds all pretty straightforward. Per annum. Okay, payable at approximately blank amount per month. We've never checked a year or the other box. So it's so much a month. So what is that? You'd put in a specific dollar amount and then the remaining principal due in a certain number of years. So let's just break this down. There are essentially three kinds of loans. There are amortized loans, there are partially amortized loans, and there are what are called straight loans, sometimes called a term loan. And an amortized loan means that you're making payments of principal and interest over a period of time, at the end of which you would have paid off all the principal. That requires a little effort to accurately calculate, right? Because you would have to know what the payment would be, including interest and the term, and there's calculators to do that. But that would be it's a little more complicated, let's just say. The partially amortized loan is where you have a loan where you're pretending that the loan is going to be paid over 30 years, but in 5 years or 7 years, it's called like a 32 and 10 or 32, and that's a partially amortized loan. And then the straight loan, which is far more common in seller financing, is a fixed term, 3 years, 5 years. I mean, how long do you want to, you're not a bank. You don't want to wait 30 years to get your money back, right? You understand? So usually the seller financing is a short-term stopgap so that the borrower can get into the property and eventually in 3 to 5 years refinance it with a real loan. Right, that's sort of the idea. So so what that would mean, let's say the loan is for $800,000, interest rate would be, so if I'm doing this, and by the way, if you're on my team, and can you see the calculator? Can anyone tell me?
Yes.
Oh, thank you. If you're on my team and you're doing one of these, I insist that you talk to me about it. But let's say it's an $800,000 loan. And the interest rate is, just for fun, going to be 8%. Right, we're going to go up just a little bit. So that would be $64,000. That's all. And we would divide that by 12, and we would get $5,333.33. Now, that's interest. Right. Now, if we paid that, now we notice if we paid 5,333, we're not paying any of the principal. right? All we're doing is paying, we take the loan amount times the interest rate and we divide by 12, and that's the monthly payment. What happens at the end of 3 years, 5 years, whatever is negotiated, is that all of the money, the whole $800,000, has to be paid back all at once. You've heard of balloon payments? This is the Zeppelin. This is the Goodyear blimp, the balloon payments. Right? You borrow $700,000, $800,000 today. In 5 years, you have to give them the whole thing back. So you're counting on the ability to refinance. What if you don't have the ability to refinance? You're in trouble. You're in trouble. So that's how, and so what I do when I'm looking at these for an agent is I look and see how much are we offering? How much is the loan? What percentage is that? And how much payment did the agent write in here? And whether or not that payment makes sense as a monthly interest payment. Right, and then balance due, that's where you'd write in 3 or 5 years. Now, notice it says in paragraph 2 that the buyer is supposed to fill out a loan application, that there should be a credit report, and all of that sort of stuff. And that this is an extension of credit. It talks about that in paragraph 3. Now, notice the choices here. Note and trust deed, all-inclusive note and trust deed, installment land sale contract, lease option, I mentioned that, or other. So, did I do something did I just do that? So I have a chart, which would be more than enough. So a land contract, I'll just start. A land contract is what it's referred to as the installment land sales contract. It's called a real property sales contract. It's sometimes called a contract for deed. It's got a whole bunch of different names, right? In the business, we call it a land contract, even though it is not necessarily a contract for land, any more than a RPA contract is a contract for land. It's a contract to buy and sell property. So the land contract is one of the ways in which you could secure a loan, right? And if you're talking in the very, very, obtuse sense, there's two ways to secure a loan. There's possession, and then there's title of the collateral. So if I need to borrow money and I go to the pawn shop and I want to borrow $500 and the pawnbroker says, "What do you got for collateral?" And I show him my Rolex watch and the pawnbroker says, "I'll lend you $500 on the watch." Right? The watch is the collateral for the loan. Now, I would sign a note that says I'm going to pay back the $500 plus interest, but that's not all that the pawnbroker wants. The pawnbroker wants the watch alongside of my promise to pay back the loan. Now, at that moment, the watch does not belong to the pawnbroker. It's not their watch. It's my watch. I still own the watch, but they're going to keep possession of it until I give them the $500 back. Does everybody understand that possession moves, but title does not? Land contracts are the opposite, where title and possession move in opposite. And it's like buying a car and financing it through the bank. Whose car is it? Is it yours or is it the bank's? A lot of times people say, well, it's the bank's car, they got the pink slip, but if the car gets, in an accident or catches on fire, the bank isn't going to come and get it, right? The pink slip isn't ownership, it's simply security for a loan. So in a land contract, the owner of the property sells it to the buyer on an installment basis, seller financing, where the seller keeps the pink slip to the house. the seller keeps the legal title and doesn't give it to the buyer until the buyer has paid off their obligation. That's tricky for a lot of reasons. The most common way to secure it is a note and trust deed. And so this would be the note simply says we're lending you X amount of money and there's going to be, these are the different terms. And by the way, knowing that the note exists is an important thing for real estate agents to understand, because sometimes agents get all caught up into all the details about amortization schedules and how do I get, well, but in addition to this document, the usually title company, but it could be a lawyer or somebody else, is going to draft the actual note document. Right? A lot of times just the title company can do it. And the trust document, which is the deed of trust, the title company is going to draft those. Right? So the specifics about the financing, that the note can clean this up later, because it's going to be another document that everybody's going to sign. Here, what we're wanting to put is the gist of what we're getting at in terms of who's lending who, how much money, at what interest rate, and due and payable at what time. Are we having fun yet? Was it, I don't know. Am
Michael, when you talk about the note, are you talking about the note as a lien against the property? Because that's something that would be very important to me if I were the seller setting this up either with, a loan or with my own cash, or advancing the credit to the buyer. I definitely would want to have something so that the buyer was not out there borrowing additional money or incurring my property. Is there something other than a lien against the property that should be done? Thank you.
yeah. So the technical answer to the first part of your question was no, but that answer might be misleading. And it's because there's a difference between the note and the lien. So a note is simply evidence that there's a debt. It does not lien anything. It's simply the terms of the repayment obligation. The lien is the deed of trust, which is a second document. And the deed of trust is the document that makes the property security for the note. But if you lose the note, they probably won't let you sell somebody's property because you can't prove they owe you any money. But if you lost the deed of trust, the note is a legally enforceable obligation, and you could sue somebody and get a judgment and use the judgment to lien the property. So if the seller is carrying back the loan, then the seller would have a trust deed. And yes, it does say in our documents that if the buyer is not allowed to encumber the property without the seller's consent. But you see, if you in an installment sale, the seller still has the pink slip, right? Which means the buyer can't do anything, right? Because they don't have the pink slip, right? They can't sell the car, right? In a note and trust deed, you've conveyed a legal title to the buyer. You've given them the pink slip. They haven't. Right now, in the preventing them from getting additional financing that would be secondary to your lien is not something you can effectively prevent them from doing, right? You can, but these are all reasons to talk to lawyers and CPAs. Any questions about that? Right. So the note and deed of trust is the typical way in which we have a loan on property. All-inclusive deed of trust, and that's coming up, right? But anyhow, you'd have to figure out, what do you want to do, right? And who should tell our clients which of these they want to do? You, as the real estate salesperson? They probably should talk
No.
to lawyers
a financial person or a lawyer, right?
Most of this most of the issues involve taxes. Just as a, I'm just saying, but the land contract is not a California Association of Realtors standard form. Right? Yeah, you understand? I mean, so that means somebody's going to have to draft one. That means a lawyer is going to have to draft one, probably. So late charges we put in usually, I forget what it is, 20, right? The transaction coordinator knows the amount, whatever it says we're allowed to do. Balloon payment is if the loan does not pay off the debt over the term, then a balloon payment is, in the civil code, any payment that is greater than twice the amount of the smallest payment. That's what it says. So if you've got a balloon payment coming in it, then you have to disclose that, because the balloon payments, which caused a lot of problems because people hadn't saved up enough money in order to cover the balloon, and then they would lose the property. Prepayment. California has laws that regulate the prepayment penalties. But this would be, what if they want, they win the lottery, a relative dies and leaves them some money, and they want to pay off the loan early. Right now, you might be thinking, why wouldn't that be good news? But it might not be, because you didn't get all the interest. So you can check the box and say that you want to charge a prepayment penalty. But again, you want to talk, because the California Civil Code actually regulates how much of a prepayment penalty you can charge and under what circumstances. And anyhow, due on sale is a good box to check, because that says that if they try to transfer the title of the property to somebody else, then during the time that they have this financing arrangement with the seller, then they have to pay off the loan. Right? They have to pay off the seller financing if they transfer the title. Due on sale. It's actually also called an alienation clause, which is a type of acceleration clause. A request for a copy of a notice of default. Financing a loan secured by a second or junior lien, a request for a copy is defined, yeah. And a request for notice of delinquency. We would check those boxes. Particularly when we get to the all-inclusive trust deed. And if you're wondering what are these, what are we talking about, is in a all-inclusive trust deed or a land contract, you might be making payments. Let's say I'm the seller, you might be making payments to me, but I'm not making payments to the lender I have, right? So I have a loan on my property, but I'm selling my property to you, and I'm lending you money to buy my property. But I already have a loan on my property. So as you make payments to me, I'm supposed to be making payments on that other loan. This is called an all-inclusive trust deed, which is one of the choices that's coming up. Right? And it's actually a felony in California if I'm that person and I'm collecting payments from you, right? Saying, but I'm not making payments on my loan. It's a crime in California. It's a form of fraud. And the promissory note, which is different than an all-inclusive trust deed, is signed by both the payor and payee, because the person says in the note, I promise that I'm going to make payments on my underlying loan. You pay me, I'll pay it. So you might want to check whether or not I really am making payments on my underlying loan, and you would be looking for a notice of default or a notice of delinquency. Shows that I'm not making the payments. And then at which point you'd probably want to come and talk to me and wonder why you're making payments to me, but I'm not making payments to them. Tax service, that's also, if you were, you want to make, would it bother you to find out I'm not paying my property taxes either? Right? You're buying the property from me, But I'm not gonna pay my property taxes, I've stopped paying my loans, good luck with that, right? So the tax service is something you can sign up for that would make sure that you're notified whether or not the property taxes are being paid. You could check, by the way, manually if you felt like it. Title insurance, usually we don't, whether or not we would get involved in that, would be somewhat depending on the type, whether or not it was an what type of conveyance. But land contracts have issues involving title. I'll get to that in a second. Hazard insurance, who's going to pay if there's a fire, flood, earthquake while the time of the seller financing? And the 13 is sort of a kickback thing, where if you get into this, the buyer gets some money back. This is not it's common enough that they put it in the form. And negative amortization. So if we take the loan amount and we divide by 12, we take the interest rate times the loan amount and divide by 12, and we got that number. Let's say it was $5,000. But the payment is $4,500. But the interest is $5,000 a month. Well, what happens is that $500 difference between the amount of interest that is accrued and the amount of interest that is paid is added to the principal. So amortization means the death of the loan, mort meaning, dead like mortician, that sort of thing. Right. So the unpaid interest is added to the principal. So instead of the principal being dead or killed off, you're taking it to the gym and feeding it a high carbohydrate, diet. Right? Every time you make a payment, you actually owe more money than you did the last time. That's called negative amortization. And California has rules about how you have to disclose that to people if the result of this arrangement is that they're going to be charged interest on interest, right? Because that's what negative amortization is, because the interest you didn't pay the first month is added to the principal. So the principal gets bigger. So that the interest that you're paying is now being calculated at a greater amount of principal, which means it's even higher, which means the amount that you're under for negative is even greater. You understand, it just starts going downhill. Right. And so you have to check those boxes. Right. And this is why they might want to talk to lawyers, CPAs, and things like that. But notice you can check that all deferred interest shall be due and payable along with the principal at maturity. Right. So we're not going to pay it. We're going to pay it all back all at once. That's the straight loan. Right. If you're making interest payments, that's the interest only loan. But that's still a straight loan because all the principal is paid back. Amortized means you're making principal payments. All right. All-inclusive deed of trust. This transaction's and so one of my Padawans is telling me his son wants to buy a property in San Diego, and he was confused. His son had showed him the documents in the transaction. It was a condominium in the Hard Rock Hotel, and he was confused, and he wanted me to look at it. And I saw at the top it said all-inclusive trust deed, and I was like, wow. It's been a while. And so what an all-inclusive trust deed is, it's when you have a seller who has a loan already. So let's say the seller has a loan for 7% interest. And the buyer wants to buy the property, and so the seller is going to lend the buyer money more than the amount that the seller owes, but at 8% interest. Now, essentially what the seller is doing is taking a loan where they're paying 7% interest and shifting it over to somebody else and getting paid a percent just for the, just for the, hey, just for doing it. right? Plus they get a little bit of cash. Now, what makes this tricky is that the loan that the seller is given, the seller financing, is not the first loan on the property. There's already a loan on the property. That's when I was talking about you have to sign an obligation that you're going to be making payments on that loan. That arrangement is referred to as a wrap or an all-inclusive trust deed. And they call that because the loan that the seller gives the buyer, although a second, incorporates in it, wraps into it the payments necessary on the first. So it gets paid off. This is also what would be called a subject to situation, which I put that explanation, I think, someplace in the handout, where you're buying property but subject to an existing loan. Right. And so in this theory, we're not going to tell the lender that we've done this, and maybe the first lender won't figure it out. Because most loans have a clause that says that you transfer your title, you have to pay it off. FHA loans don't, but most loans do. Right. But you just do it anyhow. Right. So a lot of times seller financing violates, if there's an existing loan, you understand, if the seller has an existing loan, it either has to be paid off or assumed, which is very hard to do, or taken over subject to the purchase by somebody else. Something has to be done with that loan. Right. All-inclusive trust deed, you say, forget it, I have a loan, I'm going to lend you more money, and you can move in. Now, the reason, and the case that the agent had with his son is a typical kind of thing for why all-inclusive trust deeds are used at all. They're obviously used enough that they're on the form, is that his son, who played rugby professionally in Japan, right? Not Japanese. I met him. He's like, 6'7", something like that. And he knew the people that owned this Hard Rock Hotel condominium, bunch of the condominiums, and they wanted him to move in. They thought, he was a cool guy, but all of his income came from playing rugby in Japan, right? And endorsements in Japan for products. Now, this didn't look great in a typical lender in the United States, right? And they're looking at verification of income and all this, and all of the income is, nobody wanted to make him a loan based upon that kind of an income. But the hotel said, hey, we want you, we'll do it. But they already had a loan on that unit, right? So they were lending him the money. That loan would be the second, and it would be used to pay off the first. You get the idea. Other credit terms and addendum. Eventually, there's going to be a promissory note, unless it's a land contract. Everything is going to be recorded. You can't prevent people from recording stuff. The land contract, where you sell it over time to somebody, the installment contract, should be recorded. And if recorded, and the lender, if there's already a lender on the property and they're paying attention, it can trigger an existing due on sale clause. Because there could be a clause in that property that says if you even have a land contract or even a lease option gets recorded, that's considered to be a alienation of title and triggers the due on sale clause. Senior liens, if you've got them, you have to tell about them. If there's already liens on the property. Buyer's credit worthiness. Notice they don't really have a lot of information here. But if you were doing it right, you would actually want them to fill out, the same kind of a form and process that they might if they were going to get a loan from, a real lender. And get a credit report and do all that other kind of stuff. But there's a little bit of information you could collect. That's pretty much Then it gets into this disclosure. This is the one that says if you do this too often, that you're going to be considered a lender under truth in lending. If the seller does this only once in a 12-month period and is a natural person, trust, or estate, and they're not a builder, because we don't trust builders. And it does, and the financing, notice there's some provisions here, then you don't have to fill out other forms. Right. So there's a disclaimer about the other forms. What this means is that if you do this too often, you have to comply with truth in lending, calculate the annual percentage rates, right? All of that good stuff, right? Which of course is not the goal. Any questions about this? Does that make any sense? Are we ready for?
Michael, my question would be, if they default, you gave us all the scenario to get into it, but let's say they're unable to continue to perform. What happens then? Does the property just revert back to the seller and the contract is null and void? Or do they have any claim for anything that they have paid? Thank you.
Yeah. So this is, back to lawyers again. That's a very good question. And it's what makes it murky is, let's say we're talking about a land contract, right? Is that what or were you referring to the deed of trust? Or both?
Sorry, I'm eating while I'm listening.
Neither.
Sorry, my apologies. I'm talking about not a land trust, but in essence, a deed of sale,
Okay.
while the watch is still held.
Right. Where the watch is still held. All right. So what you're talking about is the marker is, does the buyer get legal title to the property at the close of escrow? Yes or no? And if the answer is yes, then the way the seller financing would work is there would be a deed of trust that would go, and a note that would go along with the conveyance. So you would be saying the buyer would be signing, instead of signing loan documents put in by the lender, they would be signing essentially loan documents put in by the seller, saying that they're going to make payments of this amount. Now, if they don't, it would just be like any other, if they're delinquent for 3 months, they can file a notice of default. If they don't pay off in 3 months after the notice of default, there's a notice of sale. If they don't pay off in the next 3 weeks after the notice of sale, you can auction the property. And if nobody bids enough to satisfy the amount of the first and the cost of sale, you can take the title back. If it's a land contract, then you have retained, this is way trickier, right? Because you've retained the legal title to the property. Right. So so if the issue in the land contract is, what if the vendor, that's what they call the seller, dies? So what typically would happen, or often would happen, is we would say, well, wait a second, if the seller dies while the land contract is going on, then it goes to the estate and all the money they paid, and then they're going to have to sue the estate. So sometimes they would have the legal title transferred to a trust, like kind of a deed of trust kind of a thing, so that if something happened to the seller during this period, they could convey title to the buyer, and the buyer had, you can see the buyer, they one payment left, and the seller dies, and the state takes over, and it's all gone. So there are a lot of issues with land contracts, right? There's a reason we don't do them very often. They're only used in California in one regard, and I'll give anybody other than Badal somebody's going to type it in. I can't do this anymore. a Starbucks gift card if you can tell me what financing mechanism in California uses land contracts? Not at all. Anyone? All right.
Is that the farm and land form?
No, it's the CalVet, the California Veterans. And you're right, the farm, it is farm and home purchase plan. California Veterans Farm, and you're correct. That's the one. It's a land contractor. All right, but I would not, I guess, let me just put it this way. I would not suggest that a seller finance, uh, I would not, I would not be pushing sellers to do this unless they were sophisticated and had done it before and had legal counsel and, knew what they were doing.
What about Michael? I'm sorry to keep asking you questions, but I think this is interesting and it's a topic that's not covered much in anything from our association, from C.A.R or our EXP thing training. What if someone is just short? And I think you did a little scenario earlier on, but let's say someone's short 50,000 or 70,000, but you like the buyer and you think they're going to be a good person. How would you then just put the 50,000 as a lien against the property and it would convert to them? And how does the bank look upon that, just from your experience? Thank you. The lender.
Yeah. Well, so the buyer has $50,000 for a down payment, needs to get a loan from the seller. Is that what we're talking about?
No, the buyer has all the money, but they're short about 50,000.
Oh,
We'll make it easier. I saw you hurting there. I saw you struggling. It was like, oh, would she shut up and stop with these questions?
no, it was not that. I was about to say, at what interest rate? I think we could find somebody that would lend her the money.
The interest rate isn't an issue.
Call me, hey, yeah.
Well, it's not an issue. Let's say it's multiple offer situation. You find the couple you really like, you like the agent, the agent gets their deals done. Their client looks good on paper, but is short a little bit of money.
This is not talk to the loan agent about what the options could be. You could get a credit or from the seller. But there's ways of say, in fact, Badal, I'm going to give him a few minutes because why are we doing this? It's usually because the buyer doesn't have a down payment. That's why. And or can't qualify for a real loan, which is a problem, I think, if you were going to lend the money. The big question always is, does the seller have a lien on their property now? Yes or no? And if the answer is yes, now it's more complicated because it's an all-inclusive trust deed and there's a bunch more paperwork and a lot more legal stuff. If the answer is no, there are no loans on the property right now, okay, at least we have a clean start and we could begin. And so the seller would be conveying title to the buyer, but carrying back is why they call it this, the note, which would create a lien on the property for the amount that they loan, just like if they'd gotten the money through ongoing mortgage, they would have the same kind of lien. They'd have a first on the property. Which is why the initial question is, do they already have a loan, is an important one. Because
Because that would take first position and yours would take second. Yes.
And if the answer is yes, they already have a loan, my next question is, how much equity do they have? But you see, usually they're not going to get that much money because the reason they're doing the seller financing is because the buyer has a skinny down payment to begin with. So it's not like they're getting a whole bunch of money. They're probably just planning on not telling their lender, which, by the way, if you're the buyer, could be a problem because if the lender finds out that there's this loan that, was supposed to be paid off that wasn't, and they want all their money back, that could be a downside. All right, Badal, tell us, is there any other way to do this other than the seller financing? I don't think we can hear you yet, or you're talking really softly.
Oh, can you hear me now?
Yeah.
Okay, perfect. So there is a seller concession where you can have different amount of concession add into your loan amount and increase a little bit purchase price, and you can structure differently. If it is a small amount like 50,000, it might be a huge amount, but if based on the loan amount, it that can be structured. But I have like two. I just got the confirmation 80 10 10 option. So Envoy has is offering that program. And I will read the guideline in detail. I did not read the guideline yet, but I will read in detail. So if anyone has a question, reach out to me. And like the whole point is right. So when the loan amount is big, purchase price is big, you might short little bit. I have another program for jumbo loans where you don't just with the 10% down, you don't pay mi. Just I think it's better product than get additional hard hard money loans and have a second lien on the property.
That 10% jumbo gift money, any
It does allow, but I think there's a minimum requirement for down payment.
5%?
I'll read.
I'm sorry, I didn't
I'll
mean.
find. No, no. Yeah.
I'm I guess notoriously unfair about springing.
No. I think it's a good point. Like, why not? Like,
Yeah.
I'll definitely take a look. There are some liberties to get a gift fund. Uh, uh, I think it's based on conventional minimum or so whatever minimum allows, right? So jumbo allows 5%. So additional can get the gift, but I can confirm. Like
Right.
if yeah.
The last one of those I had, which eventually they were used, they got an 80-10-10, and got 5% from was a gift. Right. So the guy eventually he was trying not to take money out of his 401k. And other lenders were telling him, you needed to cash out and, that sort of thing. And he eventually found, you know, um, just thought I'd share that. I don't know why, but it hit me.
And I have seen this lender financing happen on like either mixed use on commercial a lot. Like they had a second lane, just get the 80% loan,
But,
more than 15% up to 15% is seller financing. Just buyer put 5% on commercial or mixed use. I've seen the commercial deals a lot, this
right.
kind of structuring.
And the other thing, there's a reason why land contracts are called land contracts, even though they are not necessarily about land, is because financing land. Like, who does that? Right. And we're talking about just raw land, no plans, nothing, and the answer oftentimes is, well, the seller might finance that, right? Because it's very hard to get, it's hard to get loans on stuff like that.
And I think I did mention right in one of the last session about land programs. So it's not a huge program, but up to 500,000 land you can own on 20% down. Like it's pure land. You don't have to have a plan for construction.
Yeah.
And if you have plan for construction, you can land up to 10 million with a land purchase.
Yeah, it's some of the reason for seller financing, I think, is uh, some of the reasons for seller financing from the past. We're bouncing around. Did you have more to talk about?
No, I'm
Okay.
good. I'm good.
All
Yeah.
right. So we're going to wrap it up. One of the reasons that we don't talk about it as much as we used to is because loan programs these days sort of have incorporated a lot of what would be necessary. In other words, low down payment options and assistance programs and things like that, which sort of do the same kind of lifting. Anyhow, that's enough for this week. If you have a topic that you think would be make a good session, and you want to volunteer that by sending me a message or whatever, or you can Venmo me some money too at the same time. But go ahead and do that. I'm always looking for ideas for topics. Have a good day, everyone.
Bye.